So what we're doing with this is we're saying, okay, we're going to use life insurance. We're going to build up our cash. We're going to use that to buy our debts back. Because in the banking world, that's what they do. They sell your debt as an investment. It's called factoring. They'll take those payments. The reason why I say that the interest rate doesn't matter is because it doesn't. Okay. So when you get money, when you take a loan out with the bank, I'm going to give you some insider information here. When you take a loan out with the bank, what they do is they take the payment that you're giving them. They say, okay, we did a car loan with Jerry. Jerry's giving us $350 a month. It's a 7-year car loan, right? That 7-year car loan at $350 a month, that's $350 times 84 months. 7 times 12 is 84. So what's the math on that? Okay, 29,400. So they're saying, okay, we're going to get collectively $29,400 off of Jerry over the next 7 years, right? But we don't want to wait 7 years. We want to get the money now. So they sell the future value of that payment at a discount to a bank that does want the payment that will advance them the cash. They'll sell this for, let's say, 75% of value, meaning that this $350 a month that I'm paying the bank, they're now going to give this to this other bank every single month. I'm now paying, this is what happens when your mortgage gets sold, by the way. I'm now paying this bank over here. And this bank over here is going to get my $350, but they're going to advance bank number one. What's 75% of 29,400? $22,050. So bank A is going to get $22,050 today advanced, right? And then they're going to give up that $350 a month to bank B, which I'm going to keep paying because I borrowed it. Literally, this is called factoring. Okay, so factoring is what happens in the banking world, in the financial world. They do this with mortgages. They do this with credit cards. And this payment, they can kick it down the line and resell it over and over and over. The bank that just bought it, they can then say, hey, let's sell this payment and get money for it. The bank that buys it from them, they can say, hey, let's sell this payment and get money for it, right? And it can go down and down the line. So what I'm pointing out here is banks literally do this. As a consumer, I'm in debt. I'm looking at it as I need to pay off my debt. As a banker, I'm not looking at it as debt. I'm looking at it as an asset on my balance sheet. I'm going to sell the payment, factor it, get an advance on the cash today, and then I'm going to let the borrower keep fronting that payment to the guy that I just sold it to. So when I'm paying off debt, I need to think like a banker. Okay. So the banker is saying, what is the value of the debt? How do I pay it off and buy it now from this other bank? And you need to be doing the same thing. So the life insurance allows you to build up your cash value and buy your debt back. Okay. Simultaneously, as we're doing that, we're going to use 0% credit lines to refinance your debt down to a lower interest rate so you can pay principal only on the payments you do make and get out that much faster so that you're not paying principal and interest. You're just paying principal. Okay. These are services that enhance the payment of debt. But guess what? The person that's not already making payments on debt can't do this. The reason why? You're not going to get credit lines if you're not making your payments. You're not going to get credit lines if you're not making your payments. Secondarily, you can't pay off your debt if you're not putting money aside as a surplus anyways. Saving money and paying off debt are the same thing. The only difference is once you get it, the money goes towards the debt instead of the savings account. But it's the same behavior of earning a surplus and keeping the surplus and then doing something smart with the surplus.